Hey, welcome back everyone. It is time for another red hot covered call video. Today we're going to answer a member's question. I'll just read the question. John, I'm working on the poor man's covered call in my paper trade account trying to learn it. Did you close this TNA trade yet or is it still open? I'm trying to follow this and wrap my head around this strategy. So let's talk about this because as a member, what I want to remind everyone, when I send out an email and you see the green header, that means it's a standard covered call. If you see a red header, that means it's a cash secure put. And if you see anything purple, that's a poor man's covered call trade. So in this case, this is a standard covered call where I've bought the shares and I went ahead and wrote a covered call. Now, this is actually an in-the-money covered call, and it only lasted 4 days. Now, what I'm going to do is talk about this particular trade. More importantly, the poor man's covered call strategy is complex. It does have many spinning plates. So it is important to paper trade many trades because what you don't want to do is go in without any experience or knowledge, and then you get confused and you make a bad decision. So, with that said, I'm going to do a video on the poor man's covered call where we use TNA. And in fact, I have a trade right now with TNA as a poor man's covered call. But let's go ahead and just talk about this one here. This was the initial trade setup. As you can see, I went ahead and used the stock TNA. This is the 3X leveraged ETF to the Russell Small Cap Index. We went ahead and bought 1,500 shares, paid $40.28. We gave somebody the right, but not the obligation to take our shares away from us at $39. That's cheaper than what I paid. But see, they're going to pay us in the premium, the covered call premium, they're going to pay us to hold those shares for the time frame. Now, the time frame is going to be 4 days, so this was a 1 week trade. Here we have the numbers. When they pay me $2.20, of that $2.20 is $1.28 of intrinsic value, meaning from the current stock price of $40.28 to the strike price for which somebody's going to buy my shares at $39, that is $1.28. The call buyer has to pay me that. Now, nobody makes money on that. That's just the intrinsic value. What's left behind is the time value, the time portion of the option, which is 4 days. That turns out to be 92 cents. That's the true cost of this trade. It's not the entire $2.20 because $1.28 represents intrinsic value. Or when they take my shares at $39, they have paid me $1.28 in intrinsic value. Remember, intrinsic value, nobody makes money. Nobody loses money. It's intrinsic value. Got to pay it. Now it's that time value, and that's 92 cents. So when we multiply 92 times 1,500, that would be $1,380 in 4 days. Let's talk about when I start losing money, because what happens is if the stock were to fall below $39, all that intrinsic value that they paid me right here is being eroded. And now the stock's trading at 39, 38, 99. So now anything lower, I'm losing money because the intrinsic value does not cover that. So now it erodes into my profit. And technically that profit could be used as downside protection. So the stock could actually fall down to 38.90x, right? So I could use that profit for downside protection, but I'm not going to. We're going to go ahead, place this trade, and hopefully they take my shares at 39 and we move on. And when we do a quick recap on how the trade finished, right here is that trade. I want you to focus right here, okay? So the trade was going to end on Friday, December 29th. That had been 4 days. And it did go to Friday, December 29th. I was actually in Los Angeles, and I wanted to close this trade early. And I was willing to give back 40 cents of this trade. So I give up 40 cents. So I do not make $1,380. I end up making $780 to take the trade off the board. I sold my shares immediately. So by taking this off the board, I then sold my shares immediately. We have a clean deal trade, $780. The key here is this. If this had gone to expiration, they would have taken my shares at $39. Saturday morning, the market maker would have come in and taken my shares and given me $39 per share. And then that money would have to sit there for 3 days as it settles. Well, I wanted to take the trade off the board so the money could settle quicker. And that's exactly why I did that. So I gave up a little bit to have the ability to use that money sooner. And in this case, because I'm using margin, I was able to use it immediately. And actually, it's another topic. But we went ahead and put on another trade. And that trade happened to make back all that money that I gave away by buying it back early. So we placed the trade based on these numbers. And then as the trade played out, we went ahead and bought the option back, which means we alleviated the obligation to give anybody our shares at 39. I went ahead and sold the shares immediately for whatever it was selling for, and the trade's over. So in this case, this was an in-the-money covered call, 4 days, and that's the profit we made. I ended up buying it back, closing the trade early, using all of that money to then do another trade. And just to answer that question, the 40 cents I gave back on this trade, when I decide to buy that back, I need to have another trade dialed up that's going to pay for that 40 cents that I paid to close this trade early. If it doesn't, then I would typically let this go to expiration, let the market maker deal with it. We move on. And that's this in-the-money covered call trade. Hey, look, I hope that helped you out a little bit. We're going to talk about the poor man's covered call in our next video, helping out my man. We'll talk about the strategy and how I'm using a poor man's covered call versus buying the shares. That means we buy a leaps, but we don't buy the shares. But yet, we write the near-term covered call as if we own the shares. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.